What's up, guys? Today we're talking about interest rates and the benefits of them, because there's a lot of stuff going on with the world of interest rates right now, and they're up and down and back up. But I want to show you why it's important to pay attention to what interest rates do. But first, if you get value out of this, make sure you give me a like, make sure you subscribe to the content, hit the red button, the subscribe button, and give me a comment, give me feedback on this. Let me know what your thoughts are. But let's get into it. So this is a property that I own that I just did these numbers on, and I want to put it in perspective for you why you should be looking at these sorts of opportunities. So if you own a house or you plan on owning a house, the interest rate is a very important variable to the loan, because that determines how much you pay every single month for your, it's called PITI. So PITI, so it's your principal, interest, taxes, and insurance. So that is your total monthly payment, your PITI, principal, interest, taxes, and insurance. So people will reference what your monthly payment is, and it's the PITI. Sometimes, few times, is the taxes and insurance not included in your monthly mortgage payment to the mortgage company, but almost all the time it is included in that monthly payment. But so when you say, what's your monthly payment, people will say, does that include PITI? Which means, does it include taxes and insurance? So got to know that first. But the importance of it, because the interest rate drives a big portion of what your total monthly payment is. Taxes is always the same. Property taxes and insurance is always the same. These variate, are variable. So interest is a huge key in this, when you're owning real estate, owning rental properties, owning your primary residence, whatever it is. So again, this is an example on a house that I just did. A year ago, I got a mortgage on the property for $435,000. So I got a mortgage on the property for $435,000. So that's how much the mortgage was on the house. So now you got to figure out what your payment is on something like that. So there's a couple of things you have to know. You have to know how many years is going to be on the mortgage. Some banks will give you 20 years. Some banks will give you 25 years. And traditional mortgages, Fannie and Freddie, will give you 30 years. So 30 years is the most ideal because it has the lowest payment. The shorter the time frame, the higher your payment is going to be. So 30 years is what we're going to base this on. So it's a 30-year mortgage. And then your taxes on this specific property every month. So it's the taxes every single month are $110.37. Taxes and insurance. So the reason this is so low, usually this is not this low. That's an extremely low tax and insurance payment. But the reason is that we have a 15-year tax abatement on this property, which means that the taxes for the year are like $300 a year. So like $25 a month. And then the insurance is like, $1,100 per year. So total per year for taxes and insurance is $110.37. So next big question here is the interest rate. What is the interest rate? So on this example, when I refied this property a year ago, my interest rate was 4.25%. Which, by the way, the interest rates used to be like 7, 9, 11%, like way back in the day, which made it very difficult to own property because the payment was so high. But the lower the interest rate, the lower your monthly payment. So this example, our interest rate was 4.25%. So we go to I just go to Google and type in mortgage loan calculator. You put your loan amount, you put the number of years, and you put your interest payment, how high your interest rate is, and then that'll give you your PI, your principal and interest payment. So the principal and interest payment on this was $2139.94. So if you add these two together, 21 plus 110.37 $2,250.31 was the total monthly mortgage payment on this property. So every month I pay $2,250.31, which includes your PITI, your principal, interest, taxes, and insurance. So that's what the payment was. Not bad. 30 years, 4.25%. Not a terrible rate, but not the best rate that you can get. So that is what I was paying. Then I kept hearing interest rates dropping and dropping and dropping and dropping and dropping. So I was like, you know, what if I refinance this at a lower interest rate? So when you do a refinance, there's other costs involved though. You got to take these into account. So when you do a refinance, normally you have to get another appraisal done on the property, which can cost, you know, $500, $1,000, whatever it is. So that's a cost that you have to understand that's there. So $500 appraisal fee. And then when you refinance, you have to go all the way back through the title process again. So the title has to re-update the title insurance, make sure there's no other liens on the property. They have to do all their closing documents. So you're going to pay another, you know, $1,000, $2,000, $3,000 in title fees to refinance this loan. So your fees in this is going to be, you know, somewhere between $2,000 and $5,000 to refinance this property. So if you refinance it and you only save $20 a month, it probably doesn't make sense because you have that upfront cost. But if you can refinance this and save a couple $100 a month, it can definitely change the game for you. So you got to understand that there is a cost at the beginning of a refinance. So you want to make sure it actually makes sense to refinance it. So we're going to do the same thing. So I've been paying on this for a year. So the money that I owed was a little bit less. It was probably like $430,000. So I think I've been paying on it for like a year and a half. So it's probably like $430,000 since I was a year and a half into my loan. So but the way that I did it, when you refinance, you can actually use that. So I owe $430 now, and I'm refinancing at $435. So I'm refinancing at the same, but I only owe $430 grand. So that means there's another $5,000-ish that I'm pulling back out of the property. And that's covering my appraisal, my finance costs, my closing costs, my title fees. So that is covering everything. So I actually don't have any money out of pocket. I'm not paying anything. So that's the benefit of using it as a refinance, because it's still not money out of pocket. It just goes back into the debt, into the mortgage amount. The one thing you want to be careful of, if you're like 10 years into your mortgage payments, so when you start payments, 30 years, the first payment is very highly weighted towards interest and very low towards principal. So, you know, your first payment of $2,139.94 might be $300 or $400 to principal and $1,700 to the interest payments. But as the years go, you get more principal and lower interest. And at some point it inverts. So you're paying more principal and lower interest. So if you refinance it, you're then paying more interest again and not as much principal. So the deeper you get into a loan, you want to make sure that it still makes sense. But if you're very early into your loan, 6 months, a year, maybe 2 or 3 years, doing this can save you a tremendous amount of money. And I'm going to show you that here in a second, how that breaks down. So I refinanced at $435,000. So I pulled the $430 over here that I still owed. So I pulled the $5 grand out. That paid for my appraisal, my title, my closing costs, everything. So I still don't have any money out of pocket. And what this loan looks like, it was a 30-year loan, just like the other one. Same taxes and insurance. It's the same property, so the same taxes and insurance. But this one, this interest rate was at 3.35%. So again, if the interest rate only dropped to like 4.15 or 4.0, it probably wouldn't have saved me enough money for it to make sense. But the lower the interest rate drops, the more money that you can save on your payment. So again, I typed in mortgage loan calculator on Google and I put in $435,000 loan amount, a 30-year loan at 3.35%. And what did that come out to? That came out to $1,917. So $1,917 per month in PI. So my principal and interest was $1,917. My taxes and insurance was $110.37. And if you add that up, you got 3772012. So if you look at this, between these, this is now my new monthly mortgage payment. This is now my new payment, $2,227, and it was $2,250. So I'm saving $223 per month every single month. So in a year, I'll have an extra roughly $4,500 in my pocket. $4,500 additional dollars. Is that right? Yeah, that's right. $4,500, 250 times 2, 2, 4, 6, 8, 10, 12. Excuse me, $2,500. My apologies. $2,500 a year in my pocket, additional money that I can save and not have to pay the mortgage company, which is huge. It's a benefit. But think of that over 30 years. How much money you're going to save over 30 years. So if you save $2,500 a month over 30 years, I'm not the best at math. So we're going to do this right here. 2,500 times 30 is $75,000, which means you save roughly $75,000 in interest payments on your loan. 75 grand you can save by a simple refinance. And I want to make this even cool. One other thing I want to stress here, the importance of the term. The importance of the term. So with a traditional Fannie Freddie, a property that you own for yourself, usually they'll give you a 30-year term. But if you're owning this as an investment property, if it's a second home or an investment property or an apartment building or something that's not normal, sometimes they'll only give you 20 or 25-year terms. So the shorter the term, the higher your payment is. So to put into perspective on this right here, let's assume we had a 25-year term. Just to put into perspective, 25-year term, the principal and interest payment would have been $2,357, which is $220 higher than what it would have been. But you pay it off in 25 years instead of 30 years. So there is a benefit to it, but it absolutely is a higher payment. And on this one over here, at 25 years, it would have been $2,143. So again, $150, $170 higher. So the longer the year, the lower your payment, but the longer it takes to pay off the property. So that's the difference in this. Why interest rates and why people refinance and the importance of it, because you can save a lot of money. But I want to show you one more thing. Let's just assume, so for this property right now, my payment was $2,250 a month. So I was actually paying $2,500 per month on this property, because the more you pay the principal, the faster you pay down the property. So it depends on your strategy. If it's a rental property, your tenants are going to pay for your mortgage no matter how you look at it. No matter how it cuts down, your tenants are paying your mortgage payment for you because it's a rental property and they're paying the income on it. So a lot of people will pay the minimum payment right here because they want as much positive cash flow as possible. On my rental properties, I do the same thing. On properties that maybe my personal residence or vacation home, you know, sometimes I want to pay it down quicker so I don't owe as much money, so I don't have to pay as long. So for this example here, I was paying $2,500 per month already on this property. So I want to show you what that looks like if over here, $2,027, if I continue to pay $2,500 a month, what does that look like? And how much money do you save? How quickly do you pay the property off? And you're paying the same amount of money. So I want to show you that here. So what I wanted to show you is the difference of what this changes to your bottom line. So if you were to take this $2,139.94 times 12 times 30, because you're paying on it for 30 years, you would pay a total, this is just PI, principal and interest, of $770,000, $378.40. That's what you would pay total. Now, if you look at this one, just from a simple refinance, 1917 times 12 times 30, meaning you would only pay $690,000, $120. So just off of that alone, just off of that, you'd save roughly $80,000. $80,000 into your pocket at the end of the day. Crazy difference, massively different. The other thing I want to show you here is if you continue to pay that $2,500 a month. So what that looks like, so if you were paying $2,500, remember that the principal and the taxes and insurance payment was $110.37. So I'm gonna back that out of it. So it's $2389.63. So that's how much you would be paying every single month for this payment if you continued to pay that same $2,500. So I'm gonna take that and times it by, and if you did this, if you continued to pay that same amount of money, you would actually pay off this loan in a matter of about 21 years. So you're gonna take that times 2389.63 times 12 times 21. And the reason you would pay it off in 21 years is because you're paying an additional roughly $400, $450 a month every month directly towards principal. It cuts out the interest and it pays off the loan sooner. So if you pay just a little bit more money, just a little bit more every single month, and you don't change your payment, but the only required payment is $1,917, but you continue to pay what you were paying previously, you would pay it off in 21 years. So 21 years you would pay it off. And you would have only paid $602,000, $186.76, saving you over $186,000. Saving you over $186,000. You can save $186,000 for one simple change on the interest rate. From one simple change on the interest rate. Making this one decision can save you almost $180,000 in a matter of 21 years instead of 30 years. So that's the importance of interest rates. That's why they benefit you. That's why the lower they are, the more happy people are, because the lower their payment is. When interest rates go up, it makes it less affordable. It's harder to afford a home. So people are qualify for mortgages based on their debt to income. So if you make a certain amount of money, your monthly payment can only be X. Let's say your monthly payment can only be $2,100 a month. If you got the interest rate at this, you could afford this house. If you got the interest rate at this, you could not afford this house if it was only $2,100 a month. So the lower the interest rate is, the more house that you can afford for the same dollar amount. So that's interest rates. That's the benefits of them, and you got to pay attention, and you want to get your interest rates as low as possible. If this added any value, please give me a like, hit the like button below. Definitely give me a subscribe so you can get this content as soon as it comes out. Hit the red subscribe button below and give me a comment. Let me know your thoughts on it, and share it as well. But we'll be back on the next episode.